He's here.
Jake Miller will be joining us a little bit later, but I am here.
And Micah Miller is his better half, they would say. And they are certified financial planners and amazing at what they do. The investments, and curious about what people think can be invested in. You can put it into stocks, bonds, mutual funds, or real estate, passive or active. And that's the beauty of this. It's a team effort to help you execute on the trust for the tax planning and then the investments afterwards to try to grow the wealth. We do have the Jake Carpenter here as well. Jake is with me in San Francisco in the other room as we are walking around the hotel. Jake Carpenter, how you doing?
Doing really good, Brett. It's exciting to be here in San Francisco at the Deal Flow Summit, and we're having a great time and excited to talk about the Deferred Sales Trust.
And what would you say your biggest takeaway so far of talking with some people this week? We're at, this is about 300-400 people who are in family offices and investing, as it pertains to the Deferred Sales Trust and what they've been asking and kind of gleaning from our talk so far, Jake.
You know what is so powerful about the Deferred Sales Trust is that you talk to these very, very, very educated, successful, smart men and women that are business owners, entrepreneurs from all areas of the country. And to hear them get so excited about a strategy that they just had no idea was out there, it's just that's probably one of the biggest takeaways, is that this is really a mission, Brett, that you and I and our strategic alliance is on, an educational mission to help people understand what their options are, because it's not about selling the Deferred Sales Trust. It's about making sure people know what their options are, why it works, how it works, who it works for, and what situations it can help you in. And that excitement, that curiosity that's provoked every time we speak to people. Sometimes Brett and I are speaking to people individually, sometimes together, and they get excited about these options of more diversity, more flexibility, having better control over timing when you exit and enter a new deal. So probably just the fact that they're so surprised that this is out there, even though it's been around for over 25 years, several thousand closes, several dozen IRS audits, no change, perfect track record, the most vetted capital gains deferral strategy on the planet that no one's heard about.
Absolutely. Well said, Jake. Micah, what are the questions that someone might have right now? We can start off and let you kind of moderate. And by the way, if you have questions, you can put them in the chat. It'd also be nice to find out where everyone's from. We see some new faces, which we always love to have on our mastermind. So, but Micah, anything that you'd like to kind of toss up here, and we can start to answer, Jake and I.
Yeah. So one of the first questions that would probably come to mind is why haven't I heard about this? How come it's so new?
Yeah, it's a great question. So I think the best there's two parts to this answer. One, when you have something that's proprietary and protected, it's we really expect everything to be Googleable, right? Or even Chat GPTable at this point, right? Where we can just put it into the internet and figure it out. Go to YouTube, figure it out, right? And when you have these things that are I think a little more technical for sure, right? But also protected, it's not something that we give all of our secrets away to everybody. Unless you're under NDA, unless you're a conditional engagement agreement as a potential client of ours. Even then, we're going to hold back certain things about compliance, certain things about why we do what we do, because we don't want it to be out there for everyone to take, and more so, not just take. So we, competition-wise, that's part of it, but really so that it's not abused. In fact, there's been some recent, tax strategies that in the past, they get into the wrong hands and people take them too far. And then when that happens, the IRS doesn't like that, and they tend to shut things down. And that's what we don't want to have happened. And so the Deferred Sales Trust itself, there's just a select few who know how to do this. I played basketball in college, and I tore my ACL on both my knees. And I remember walking into the surgeon asking him about how much track record he had for what he did. Because I had never done an ACL surgery before. It was my first knee. I just signed a scholarship, and it was brutal to get the ACL blown out. And And I had questions and like, how are you going to fix me? And you're going to cut me open and you're going to attach my hamstring. He's going to cut my hamstring and he's going to use that as the ACL ligament. And that blew my mind. And I said, well, why don't we do something else? Ask him certain questions, but I just didn't know what I didn't know. And I think that's the biggest expense for everyone listening. And even, it's a reminder for myself, is the biggest expense we have in life is the things we don't know, right? Or even the things we think we know. And what's neat about the deferred sales trust, and with my surgery, this guy had done thousands of surgeries, and he had also did it with Chris Webber. And so that gave me confidence to know that this guy has had a proven track record for surgeries. So I trusted and had faith that what he was going to do was going to turn out well. Same thing with the deferred sales trust. We're not asking people to step into something new in the sense of it's never been done. It's been thousands and thousands of closes, billions and billions and billions of assets have used it for sales. And it's never had a single failed IRS audit, but there's really one law firm that has this track record. So it'd be like that one surgeon who could do that surgery in a certain way, that just because the other surgeons don't know how to do it doesn't mean it hasn't been perfect. And that's the thing, it's batting 1,000. And that's what gives me us the confidence and the conviction to go all in on this strategy because of that track record, almost close to 30 years. But guess what? Your CPA or your tax professional or your real estate agent or even your financial advisor, a lot of them are general practitioners. And there's nothing wrong with that, but they're more like the family doctor that you come in and he gives you the flu shot, right? And gives you the updated blood work and might give you some antibiotics to solve, let's just say general problems. But the specialist is the person who's going to solve the big problem, like the cancer or the ACL surgery or the knee replacement. I was meeting with potential clients yesterday, and one of the gentlemen, he played for USC basketball, okay? And it's really great. He played against John Wooden's team, and they actually beat UCLA one of the years that UCLA won the championship. They beat him in the regular conference game. And he's getting this knee replaced. I'm going, oh my gosh, like that's maybe me one day because I played basketball growing up and maybe my knees are going to give way. But the point of all that is it's going to be successful because he's working with someone who's proven the track record with that. And so your CPA is like that general practitioner who's not going to do that knee surgery. He's not going to replace your knee. They're going to do the exit planning. Too often, a lot of people get caught. If he doesn't know about it, then I'm too scared to do it because maybe it's not going to work or it's not legal. And so hopefully that answers some of the questions, Micah. Is still getting out there, but it's protected, and your CPA probably doesn't know about it because they haven't done it, or if they do have heard about it, they still haven't seen somebody do it. And so it's that tension between what's happened and that person knowing it. Is that making sense, Micah?
Yeah, no, absolutely. And that's really what it comes down to, is where there are typically like a one-time event in your lifetime where you're either selling your business or you're selling off all of this real estate that you've accumulated over your lifetime. And it's not an everyday transaction. It's really just something that happens once in a great while. And that's probably a big portion of it too, why some of the CPAs that you're talking about haven't heard about it too, right? They haven't come up into that situation where they needed it.
Yeah, and here's the good news. The CPA and tax attorney who created it, he's a CPA. So we're not asking you to say no to a CPA. In fact, you say yes to a CPA. This CPA and tax attorney is the one who's actually providing the legal representation, the tax advice. And sometimes people think, oh, I need my CPA to say yes because they're the person filing my tax return. And therefore, if I get audited on this, they're the ones going to have to defend it. And they have no confidence to defend it, of course, because they haven't done the surgeries, right? They haven't done the thousands of closes. But realizing that Capital Gains Tax Solutions as the trustee and the law firm who does all this, they're the ones who represent you. And they're the ones who walk your CPA step by step on how to report it. And if the audit comes, it's lifetime audit defense. So when you go, oh, okay, so I'm basically hiring a specialist CPA and tax attorney for this particular transaction. Yes, right? That's exactly right. Just as if you would hire someone to do a nail surgery or knee replacement or whatever else, and your general practitioner is going to refer that out. Now, here's the reality. The CPAs who do join us or who do learn about what we're doing, they end up joining us in the fact they start sending us referrals. In fact, we just closed a deal. It's a $10 million sale. Jake Carpenter, maybe you want to talk about that and how many referrals are already coming from that, and their tax professional who was at first skeptical. Jake Carpenter, you want to talk about that one?
Yeah, it's amazing. I mean, it's a similar situation with every deal, but we closed a deal, $10 million gross sales, he was selling 5 mobile home parks. He was so excited at what the process that he went through that he told everyone in his circle. I think, Brett, we've probably gotten 24 referrals so far that we started working with since we worked with Gary in the sale of his mobile home parks. And it's just amazing because once they go through the process and they see, okay, it's not an easy, it's brain surgery, but there is a professional team to surround the situation and the transaction and the surgery so that you can get through it with fairly little, stress and worry, because you got professionals surrounding you and building this plan alongside of you. And because of that, he referred us to so many different people that are now going through the same process. And let me talk a little bit about that process, if I could, Brett. Due diligence is one of the most important things with this strategy. It is somewhat complex. It's not super simple, but you have a team of professionals to surround you, to teach your CPA, to teach your attorney, to answer questions. The due diligence process is very, very important. And I saw a question in the chat about how long does it take to set up the trust? How big does the transaction need to be? It needs to be at least $1 million in net proceeds and at least $1 million subject to capital gains tax. If it is that size or larger, then it would qualify for the deferred sales trust. We recommend that you start your due diligence at least a month or a couple of months ahead of time so that we have time to educate your CPAs, your attorneys. Even if you don't have a pending sale, I would encourage you to start the due diligence if you're looking at selling highly appreciated assets in the future. Maybe you have 2 different assets that are a net proceed of $1 million subject to capital gains tax. As long as you're looking to sell those within 1 year, then that would also qualify as well, because we can wrap up multiple transactions into one trust. So start your due diligence early. The process is not that bad. It's just that it is a process. So you have to go through it, get everyone on board. Then we get quite a bit of excitement and a lot of buy-in, and we got everyone rowing in the same direction. And it can take a fairly quick period of time to set up the trust. In fact, I've even seen it set up within a few days. But you want to stay ahead of the game and give the attorneys time to set it up. So 2 to 3 weeks ideally. But yeah, with that said, I'll let you kind of finish up there, Brett.
Exactly right. And you can learn more by going to capitalgainstaxsolutions.com. And then Jake will also give his information as well. And then other Jake Miller just joined us. I'm going to tee him up here just a second. So that's kind of a kind of quick crash course on the deferred sales trust. By the way, there's a new book that just came out, Building a Capital Gains Tax Exit Plan. You can also pick that out on Amazon if you want to learn more there. And you can schedule a one-on-one consultation as long as you can apply for that, as long as it's $1 million net proceeds, $1 million gain. That's important. And you got to set this up prior to the close of escrow. We recommend even prior to even listing the asset is the ideal. Now, this works for stock, cryptocurrency, businesses, S Corps, C Corps, LLCs. It works for primary homes. It works for investment real estate. It works for really any asset of any kind. It works for artwork collectibles. It works for working on a plane deal, like a jet that is like a private jet. We're working on that right now. So it works for any asset of any kind, as long as we set it up prior to we do the planning. Now, the neat part too is it's all no cost, no obligation planning, meaning we will sit down with you and your CPA and walk you through step by step what it is, how it works, where the money is going to be invested, how it's going to be invested, all of those things. Can you be active? Yes. Can you be passive? Yes. You can be an entrepreneur, or you can be retired. You can diversify. It's really that flexible. Now you have to work with the trustee. That's me. Hi. This is what we do. We're the third party unrelated trustee, and we help to basically kind of be like the quarterback sometimes, and sometimes the offensive coordinator to keep everyone organized with everything that's happening. But that's another part of this. You're not just deferring the tax, you're getting a team. And we like to call it like a family office type of environment where you have specialists that Jake Carpenter, for example, is a financial advisor. Jake Miller, who's going to come on in a second, is a financial advisor. And we all work together to help to organize and structure and invest. And you're getting a team to help you invest and build your wealth. A lot of entrepreneurs we work with, or even real estate successful investors we work with, they're used to doing everything on their own, and they're looking for that team, And so we talk about having a clear vision for your exit plan, what it is that you want to do, having a clear vision with what the tax is going to be, and then also having building a team to help you achieve where it is that you want your wealth to be, and how in a tax efficient way. And so that being said, I'm going to have to walk into the.
Hey, Brett, one quick question right before you go on stage. I know you're going to be going on. John had a question, and I'm going to slaughter how he said this, but he said, do you believe that the DST will survive the reach of congressional kleptocracy? Cleo, I don't know how to say that word, John. I'm sorry. Maybe you want to unmute and say and ask a little bit more.
Kleptocracy.
Kleptocracy. Okay. I am not familiar with that. I don't know if you are, Brett, or if you can answer that, or if we need some more clarification from John.
Give us more clarification. I'll try my best.
Yeah, I mean, basically, you look at the federal, budgets, the deficits that are running. You don't have to be too smart to figure out that there's only one way that taxes are going. They're going to be reaching into our pocket, hence the reference to kleptocracy. And I'm wondering if this DST is going to be able to survive, the coming onslaught from what I anticipate Congress doing in terms of reaching into our pocket more and more.
Yeah, it's a great question. I mean, I'm from Taxifornia. We just moved to Florida. Okay, California. I love Florida. I love California for a lot of reasons. The leadership has failed us here, right? And they've spent a lot of money that they didn't have, and they, the debt is now $32 trillion. So it's actually probably the most important question that you could be thinking about is how can we make an impact with these types of strategies to actually help to solve some of these crises. The other crisis we're also looking at is the housing crisis, right? 4 to 5 million units short across America, and things like opportunity zones were put into place so that we can encourage capital to build in areas and create more housing, for example, right? Things like the 1031 exchange have been in place for many, many years so that wealth would continue to flow and move. And the study of macroeconomics, it creates more jobs, creates more housing. The same can be said for IRAs and 401ks. The government's not in the business of retirement, right? And in fact, they're not very good at housing or retirement, much of anything really, right? And so unless it's maybe national defense and some other things, but at the end of the day, we can't control what they're going to do or what they're not going to do. What we do feel, and why the 1031 exchange has not been eliminated yet, is that it does serve the growth of capital. And actually the biggest winner here is the government, if you believe it or not. Some people think, oh, well, maybe they somehow not, getting paid. They're getting paid. They're getting, there's taxes on this. For example, we did an $8.3 million sale in Palo Alto for a highly appreciated house. And, the property tax basis, basically in California can only go up so much per year. And essentially they got a new property tax, right? Rate based on that new buyer. I also get taxed on as trustee fees, the actual note holder, as they receive payments, get taxed. And so otherwise, we think stagflation kicks in. When people are not incentivized to sell assets due to tax, money doesn't flow. And if money doesn't flow, things stagnate. If things stagnate, that's when things really decline. So although we don't know what the government's going to do or not going to do, we do feel very confident in the structure, being that it's IRC 453, which is an installment sale. And what that goes back to basically like the 1920s. In the 1920s, as you remember, there's a lot of stuff. 1920s and 30s is kind of when this all went down. You had the Great Depression. You had a lot of stuff going on there. And essentially, they created the installment sale as a way to not have to have government banks for everything, right? In other words, allow the private person to carry paper in order to move properties and move assets. And this is what we do. It's a seller carryback with a trust. So we do believe that the foundation, the structure is sound. This is part of why I think the audits have all been no change, no findings, because we do it in a correct way with a third-party trustee for business purpose. But you're right. I don't know, John, what they're going to do or not going to do. What all we can do is focus on what we do have today, which is it's working, and we hope that they would also see that it's actually good for everybody. That being said, I've got to go, everybody. I'm going to be late. I'm going to pass it to Jake Miller. Jake Miller is a certified financial planner. He is one of our top strategic alliances financial advisors in the country. He's also very entrepreneurial. He understands real estate, and he has a really keen mind. So that being said, Jake Miller, take it away.
Thank you so much, Brett, and present well and make us proud. Thank you so much. Hey, touching on that topic just a little bit more, Brett was super quick, and he commented really, really fast on the fact that this currently has a 100% track record beneath all audits, reviews, and IRS notices, which it's something incredibly important. It's almost unseen in all the area of tax strategies. Typically, when you're thinking of a tax strategy, or hey, how do I mitigate, defer, or find an exemption for something that's about to occur or that will occur in the future, you look at when it does work and when it doesn't work, and you try to find out, is there gray area? How much across the line can I be? All this other stuff. With this strategy, you don't have to. Now, that doesn't necessarily give you peace of mind with our current legislation, because we can't control what they'll decide on. We can't control what they'll do. And you're right, there's this trend of more and more and more taxes, new forms of taxes, increased tax rates, all of that other stuff, which makes strategies like this, and nobody has a crystal ball, but I would think that strategies that have been batting 1,000 so far have a greater likelihood of not being the target for change in the future, in the most immediate future. But again, of course, nobody has a crystal ball. Nobody knows what our legislators will do. We can stay as informed as we possibly can. We know that there's also a lot of hidden agendas out there politically. We won't really dive into any of that. But as far as what we are doing today, what works today, as far as a deferral strategy, this is one of the best for individuals who are having a business exit, or individuals who are selling a highly appreciated asset, in the sense that you are able to defer 100% of the transaction to the future. And you now have power over the timing of when you, to some extent, when you take receipt of those funds. Depending on the size of the transaction, you might have some leeway over the next 10 years of when to take some of that out. If it's a very large transaction, you may have to annuitize some of it. However, that is definitely a deferral mitigation tool for you in regards to what would otherwise be one of the largest transactions of your life, and perhaps one of the most taxable, or one of the largest profit sharing events with the government that you'd ever have. And if we can help mitigate that with either a deferral, a deduction, or an exemption, happy to do so. This deferred sales trust falls under the categories typically of a deferral and sometimes a deduction. So I don't know if we want to touch on that anymore, or talk about post deferred sales trust creation, what you can do with the deferred sales trust.
I think that would be a good idea to go into what you can do after the deferred sales trust. What kind of investments have you seen, both of you Jakes, as far as investments that people, okay, they might have a business, they might have real estate. Are they limited to what they can go into in the future, or what have you used with your clients?
Yeah, Jake Carpenter, if you'll jump on that, and then I'll pick up the tail afterwards.
Yes, okay. Sorry, what was the question again?
Oh, sorry. Yeah. So what kind of assets have you helped with your clients to invest in after the close of the DST?
Oh, that's exciting. So when Brett says that we all work together, he literally means that we all work together. So Jake Miller, financial advisor, I'm an investment advisor, but we actually work together quite a bit. So Jake is really talented at putting some very, very solid funds together that some of my clients like to invest in those funds. And those are things from short-term rental funds to, one of them was a casino in Colombia, Medellin, Colombia. Syndications of different kind, multifamily, commercial, medical, professional, stocks, bonds, mutual funds. You think of it you can pretty much invest in it through the deferred sales trust. You can do hard money lending. You can keep most of it as dry powder for looking for another deal when the timing is right. So, and that's kind of the power of the team, is we're all helping each other find a place to park the cash that's going to yield a return that's going to actually make this an asset for the seller, right? Because the fees to run this trust on an annual basis are between 1% to 2%. But what you have to understand is that we have to, generally, if people are active, they're going to do 10, 15, 20% rate of return over time. And Jake Miller and I are looking for investments that will, net after expenses, put 5, 6, 7, 8% income return in the investor's pocket, plus maybe some capital appreciation on top, depending on what their goals are. So we're in this thing to make it an asset to the seller, not an expense or a liability. And you have to keep in mind that it's 25 to 50% of the proceeds that are back in your pocket that's able to generate income and growth for you in the future. Not just for you, but you can continue to defer, renegotiate the note every 10 years until you pass away, and then your kids or your beneficiaries can step in and take over for you. That said, I'm going to have to run because I want to go see Brett talk, but you can reach me or get a hold of me at 509-396-5292 or www.carpentercapitalllc.com.
Awesome. Thanks, Jake. Appreciate you being on the call.
Thank you, guys.
All right.
Good, thank you. Now, Micah, I do a lot of talking on these calls, and I was thinking that it would be good to introduce my Vice President of Latin American Operations, so projects south of the border, so to speak. We have with us here today Juan Sebastian Perez. And Sebastian, would you please kind of tell the audience, now, of course, we've got plenty of projects in the States and everything else, but give them a highlight of some of the projects that we're working on currently south of the border.
Well, thank you so much for the introduction, Jake. My name is Sebastian Perez. Right now, like Jake told you, I'm the Vice President of Latin American Projects. Right now, we have several projects that we are working into. The perspective of Latin America, especially countries like Colombia and Mexico, is really big. We are understanding that right now the economy is growing. And for that, we understand that it will be really interesting to know about this culture. So right now, we have a couple projects in real estate projects, in the understanding that right now the short rental are a huge opportunity, because right now we are receiving a lot of people coming here to Colombia. The first semester of 2023, we have an increase of 34% of people coming here to visit Colombia. That's a huge indicator to understand that right now we have plenty possibilities to develop several business opportunities. So we have a great opportunity in the gambling industry. Right now we have one of the most beautiful casinos in the city of Medellin, a city who is right now placed as one of the most innovative cities in Colombia and Latin America. We have real estate projects talking about short-term rental. And we have also seen another projects in different countries like Mexico, understanding that they have opportunities in the bottle industry. And right now we have another several projects that perhaps they can tell you about.
Thank you, Sebastian. And so just to highlight a few different things, Forbes magazine and Times magazine has named Medellin as one of the top destination places for 2023. So not just tourism, but industry, and out of all of the cities in Colombia rising in businesses, Medellin is definitely a good spot. It's a targeted area. So that's why we're buying and selling real estate there. And we have the opportunity to pick up government repo properties. We have the ability to pick up other really good investment deals, tweak them a little bit, and then sell them quickly. Those types of opportunities don't exist everywhere, and that's just Colombia. That's very exciting and very good, the things that we have coming up here soon. In Mexico, we have a bottling and co-packing plant. So companies such as energy drinks like Jolt or Nestle with water bottles, or any number of these other co-packing and bottling opportunities that exist in Guadalajara, Mexico, such as the liquor industry, we're able to be a part of that in a constant, stable, consistent cash flow way by providing the service of bottling and packaging their liquid products. And so that's very exciting, as well as we're vertically integrating into the facility, vertically integrated into our own brands of tequila, vertically integrated into the agave plants themselves. And that way we're able to control prices and move things forward. And so when we're talking about deferred sales trust, it's important to know that, as Brett mentioned, the sky is wide open as to any type of asset that has appreciated greatly, and you would otherwise suffer an immense profit share with the government in taxes. You are able to utilize the deferred sales trust to essentially roll that asset into other assets. Now, that the other assets could be cash, of course, bank account, treasury notes, marketable securities, or any of these other investments that we're bringing to the table, or any other investments that you bring to the table that meet the qualifications for reinvestment purposes. Now, some people ask, I'm an entrepreneur myself. I don't need other people's projects. That's perfectly fine. The deferred sales trust can partner with you in your own projects, your own business deals. Should you do a joint venture or a partnership with somebody else, the same can be said with the trust. You and yourself or your business can partner with the trust in a new venture, and that works out just fine as well. So the flexibility of what you can do with the deferred sales trust, whether we're investing in real estate in the States, whether you're investing in another business in the States, whether you're expanding or growing or doing a startup, or if you would like to benefit from some of the opportunities worldwide, that is also available with your US deferred sales trust. Looks like we have a few questions coming in. Micah, can you spearhead those?
Yeah. So Terry wanted to know, can one take distributions that would be taxed as long-term capital gains from the DST? So that's what we're talking about essentially, is the long-term capital gains, right? So you can take a distribution, you can set that up initially, and you can, when you visit with the tax attorney, you say, you know what, I have a $1 million sale or $1.5 million sale. I want to receive 200,000 right now up front. You absolutely can. You would get taxed for that you receive. And that's kind of the beauty of what it is. If you want to receive something, I mean, you've had that asset forever, right? It's your money. You can do what you want to do, right? And then the same thing is if you say, I want to set it up, I want to receive 200,000 now, and I want to receive 3% every month after that, or starting in 2 years after I build up some interest, and so you're not actually touching the principal of the investment, which is kind of a neat little feature. So, Jake, I want you to try to hit a little bit about the options that are available for changing partnerships. If you have multiple partnerships and some want to cash out and some don't, and some want to reinvest. I want to see if you're able to answer that. I don't know if you're able to or not, but you are muted. So that is one thing that the deferred sales trust can do. It gives you flexibility. So maybe you've had 1031s that you've rolled over in the past and you've reinvested into another project. Well, maybe that was good when you were younger, or maybe you're wanting to use some of the proceeds, right? So it really helps give you flexibility. You can set up a DST, your partner can set up a DST, or you know what, maybe their third partner wants to receive the proceeds and get taxed on it. That's okay too.
I would say that some people, Mike, in fact, I have quite a few people, when they are getting to a stage in their life where they just want a break from work, or maybe it's their retirement, and they've worked their entire life to build this asset or this cash cow business or whatever it is that is worth a lot of money and would otherwise be heavily taxed should they sell it as is. They utilize the deferred sales trust to help them sell off into the sunset. That is one scenario where people essentially use it as their retirement plan, where not all at once do they have to take on that tax burden. If they have a $5 million business, they sell it They don't have to lose 20%, 40% of their business because of that sales transaction. They can continue to put that money to work from the sales proceeds within the deferred sales trust so that the time value of money is still on their side and they don't have to chop up their piece of pie and make it smaller so that they can live on it going forward. They can set up installment payments to themselves, monthly payments. They can set up, hey, every year I need X amount of money to live off of, and they can just let it keep going until it extinguishes, or should they have sufficient there and their cost of living is small compared to what they have in the assets in the trust, they can leave it to their legacy. So the deferred sales trust works incredibly well as one of the pieces in somebody's estate and personal financial plan. And that's something also very important for people to consider. That the deferred sales trust, similar to an IRA, as you're buying and selling things inside of it, you're not incurring taxes every time you buy and sell. It's kind of like a 401k where if you own Coca-Cola and you sell Coca-Cola and you buy Pepsi and then you sell Pepsi and you buy Apple and you sell Apple and you buy Google and you sell Google, you're not paying taxes every time. You're only paying taxes as you're taking distributions out. Now, part of this function, there is a promissory note against the assets of the trust. And this is what protects you as you're putting assets into a third-party administrated trust. You become the lien holder with this promissory note. This protects you, gives you creditor rights over the assets of the trust. That promissory note is a requirement. It does have an interest rate. And that interest rate, when paid out to you, is taxable at ordinary income rates. A lot of people choose somewhere between 6, 8, 9%, just depending on what their needs are, their specific circumstance. Some people take that as income as if it were like, self-employment income to themselves. And sometimes that is sufficient. They can leave their assets alone, the principal, and not take anything from it, and they can just live off of the interest payments, and they can institute other tax mitigating efforts to offset the tax burden of that ordinary income that comes back to you. But to your point, Micah, whenever anybody takes an installment or anybody takes distribution of part of the principal, that comes out to them as capital gains, as a capital gains tax rate. And that can be more efficient based on a number of other different factors. Typically, the deferred sales trust is the first part of a really big plan that a lot of people have when they're selling perhaps a really large asset or perhaps having the largest sales transaction of their life. When I say it's part of a really big plan, what are their goals? What are their objectives? Do they need cash flow? Do they need to leave a legacy, etc.? This solves today's issue of what would otherwise be a highly taxable transaction. There's additional planning for the here and after of what people should be doing and thinking about when handling distributions from the trust and when investing with the trust and when thinking of legacy planning and when thinking of other business ventures. Are they going to be actively participating in more and more investment activities, materially participating alongside the trust? All of these things require planning. And that's why we sit down with these clients. We educate them on all the things that are important and relevant in regards to their sales transaction. Also, the longevity of or the duration that they utilize the trust going forward. I hope that's helpful. I think I'm filling in some of the little holes here and there based on what we've talked about so far.
Yes, absolutely. So I want you to speak a little bit about just kind of what the numbers are and what needs to happen. So like there's a question in regards to a step up in basis on the death of the originator to heirs, right? So what kind of numbers?
There's a step up.
Oh, go ahead.
There's only a step up for those people who have an asset and they leave it to their heirs. Should they use a deferred sales trust? They're not leaving the asset to their heirs. They're selling the asset. So there's no step up in basis with the deferred sales trust, if that makes sense. What they get if they're reinvesting in real estate is they're getting a new depreciation schedule. And that is oftentimes a huge win. With a 1031 exchange and a lot of these other things, when they sell a property and they buy into a new property, they're rolling over the basis, they're rolling over everything that happened over here into what they're buying over here. They don't get a new depreciation schedule. And so that's the power of partnering with your trust and buying new properties, real estate specifically, because there's that additional tax advantage of getting a new depreciation schedule. But as far as a step up in basis, when doing planning for individuals in the beginning, we need to identify what it is that is their goal. What is their goal and their objective? Do they want to leave this mansion, cabin, house of theirs in the mountains to their family? Well, you don't be eligible for a deferred sales trust. You have to be selling something to be eligible. So that doesn't, if mom and dad don't want the kids to squabble and fight over these assets, and mom and dad want to plan on and concrete into their estate the value of these assets, that usually means that they're planning to sell certain assets before they're passing, or before, as they're getting on in years and things of that nature, and they want to make sure that things are equalized, or that certain kids have sufficient, or whatever their plan is. If they want to establish that before death, oftentimes that means that they start consolidating things, moving things around, and selling them. If they are selling an asset that is more than $1 million and subject to more than $1 million in capital gains, it's a no-brainer. These are not hard and fast rules, but at that point, it's a no-brainer that there's enough tax paying that a deferred sales trust is a usable tool, that it works and it makes sense, and we don't even have to do the math at that point. If people are selling something that's like 500,000, if they're in California, or if they're, some of these other highly taxed states, it could still be a good deal. But at that point, we have to crunch all the numbers. We have to work with your CPA. We have to work with all these other people just to make sure that it's the best option for you compared to other tax strategies.
So a lot of times people, you mentioned too, I mean, it doesn't have to be one sell, and it doesn't have to be used one time. You could have multiple properties that you're selling within a reasonable amount of time that could cumulatively be about $1 million, right? Or
That's
you
true.
could have a sell later on that you want to add to. I mean, we see that all the time as well. But I mean, a lot of times you have investors that are buying and selling real estate all the time, and so you end up getting a debt over basis issue. So how are you helping people with that?
Absolutely. So a couple different questions there. Plus, we have another question from Terry saying, you provide investment planning services to your clients. That is true, but in a number of different ways. And we also accept advice and counsel from other people that you might bring to the table. What I would like to say is that we are a fully equipped shop with all services needed, but we also work really well with others. Sometimes our clients have a plan of everything that they want to do. We have a real estate developer in Arizona who always has a plan of where the money needs to go as soon as there's a sell. And we help facilitate that in the most efficient way from a tax standpoint, which is one of his biggest goals, is to continually defer the gains on all of these developments that he purchases, builds, and sells. Purchase, build, and sell. Purchase, build, and sell. And that's his mode of operation. That's a very specific thing. Other clients are looking more to us for a lot of advice and help and support. And we can help them participate in investments that they would otherwise perhaps not have available to them. We have everything that's available in the stock market, just like other financial advisors. But we're a little bit more than just financial advisors. We have a lot of private placements, a lot of alternative investments that are also eligible to be invested in, as well as, because of the trustee that we use, Brett Swarts, we're able to help people invest in assets that otherwise only qualified clients and individuals of a much higher net worth would be eligible to participate in. So the pool of options just got a lot bigger for you, should you need or want those options, which is a huge advantage for a lot of our clients. In addition to your question, Micah, sometimes, and I'll tell the story of an equipment rental company. This equipment rental company, I think it was in Georgia. They had a debt over basis issue. They were going to go sell their business. It was like a $32 million sell. And they were looking for ways to mitigate the capital gains on the sale of their business. And you would think that $32 million later that they would be a little bit more up on their own accounting and taxes and things. But eventually, after about 4 meetings of educating them and helping them and everything else, they finally brought their CPA to the table. And we found out that this individual has grown his business and several others by borrowing from the business or taking loans against the equipment of his equipment rental business to fund outside ventures. All of those loans created what's called a debt over basis issue. When somebody starts a business, they put money in, that's their basis. When they take money out, if they're taking out capital that they've contributed, they're decreasing their basis to a certain extent. If they are taking loans against the business, a loan is not income until at some point that loan is either forgiven because you've sold the business or paid off because you've sold the business. All of those loans that he used to help build like rental properties and other things on the side came back to bite him. He was going to sell his business for $32 million. He had a couple loans in the name of the business, and he had all these loans that were, used for other businesses that he used his business collateral for. At the end of the day, when it comes to basis, which is important for figuring out what your capital gains is, his basis was in the red. I want you to visualize that. So ground zero shows us, anything above that is an offset against capital gains. Anything below that means that, hey, if I'm selling it for 27 million, but I have debt over basis, I need to add to that sales price so I know what's going to be taxable. So instead of being taxable at 27 million, he was being taxable at around $40 million. The proceeds from the sale of the transaction wouldn't even cover all of his tax bill necessarily. And so he was steeped up against a big problem because he was ready to sell. He had a buyer. And one thing that was impeding him from being able to sell the property was having to pay the taxes on all of these loans that would now be recognized as income to him in a debt over basis issue. So what we did is we rolled over into a debt instrument known as a Delaware Statutory Trust Fund or a zero coupon Delaware Statutory Trust Fund. We took a little bit of the cash from the sale of the business and all of that debt. We rolled that into a different financial instrument, and then we took the rest of the cash from the deal and we put it into the DST. And that allowed him to continue to use his deferred sales trust as a passive financial partner in a lot of his future deals, while simultaneously at the same time solving the issue currently or deferring the issue of the debt over basis in a debt instrument. I believe we did partial Amazon warehouse and another whatever, to where they accepted his debt and part of that debt is being paid off over time through the investment itself. And so we helped him where he would otherwise had to come out of pocket to pay taxes on a deal that he's hoping to get money from, and he wouldn't have gotten any money from it, to now having a big cash cow deferred sales trust that he can reinvest in projects, and debt over issue pretty much solved with these other financial tools. So I hope that helps answer your question.
That's wonderful. I think we ought to open it up to Q&A in the last few minutes that we have here. I want to give some people maybe some time to answer any other questions that might come up or might be in their situation. Terry, you just typed one in. Do you want me to read it? All right. How long after the sale of a syndication exit would the profits need to be rolled into a DST?
So the DST is the recipient of the escrow. So it all happens immediately. This is not like, hey, if I take money out of my IRA, my IRA. If I take money out of my IRA, I have 60 days to show that it's effectively rolled over into another IRA or something like that. The deferred sales trust, we put it in between you and the buyer of the transaction. We do it prior to the sale. We do it the day of or the day before, or whatever else. And we do an exchange of this promissory note that makes you a creditor of the trust assets. The trust then is the seller of the asset. The buyer buys from the trust. The buyer puts money into the trust. You don't ever receive the money, which is why it's not taxable, if you have not taken constructive receipt. All of this structure, the fact that we have a third party, unrelated, unknown to you, trustee, Brett Swarts, right? And that we have a trust that's set up, all of this mechanism is in place so that the IRS, with beyond any doubt, can say that you never received the money. If you never received the money, you don't have to pay taxes on it. Your trust is an eligible entity, think of it like a 401k again, can receive the proceeds and invest them again. and sell them and invest them and sell them and invest them and sell them and invest them. And because of that, we're deferring the recognition of all of those taxable transactions and essentially making it so that they're not taxable now. When you take the money out in the future and use it personally, then it's taxable. But because of that mechanism, at closing, it is the entity at the table at closing that receives the proceeds.
And I would also add that Brett is the manager. He manages the trust, but he only manages it under your direction. So anything that happens, you sign off on as the note holder, because I mean, think about it as a mortgage. Your mortgage owns the note on your home, right? And so what happens to that asset is that mortgagee, it has to be paid off first before you actually would receive it. So anyway, it's a neat way to think about it, because there are a lot of checks and balances in place. The only time I've ever heard Brett bat his eyes at an investment was when an investor said, I want to put 100% of my proceeds into crypto. And he said, hold on, let's think about this. Maybe we can do a sizable amount, but let's think about diversifying, you know. So he's very friendly in the sense that if you say, I've got a friend who has a business and I want to invest in that, and I have other ideas, he's open to those ideas. And we just write up an investment allocation and both of you sign off on it and Brett executes it. It's a beautiful piece of work. All
Wonderful
right.
question.
All right. Are there any other questions, burning, desiring questions in? This has been good though. We've had some good questions recently. Hopefully we've been able to explain the process and say, okay, this is how it goes. This is what you do. And actually, the next steps, I would say, is to jump on a call with Brett, the attorney, and one of the investment advisors. And just, you can ask any question and say, hey, this is my scenario. This is how much I want to get. This is, you know, and maybe I have a buyer lined up. Maybe I have somebody who's thinking about it. And that's no obligation at this point. It's only going to be receive proceeds. It's a conditional arrangement. So you're really not out anything just to talk.
Very good. All right. So essentially, for a no obligation consultation of whether a DST is good for you, reach out. Brett Swarts, strategictaxsolutions.com. Our company is called, I think I had that backwards. Brett Swarts is capitalgainstaxsolutions.com. Our company is strategictaxsolutions.com. All separate companies, all working together to help solve an issue that would otherwise be your largest profit share ever with the government that can be deferred should you use a deferred sales trust. All right.
Very
Well, Micah, I
good.
think that's all for today.
Yep, I believe so. All right. Well, thank you everyone for being on the call. Like Brett said in the very beginning, it's just our mission to try to get more people involved and knowledgeable about the Deferred Sales Trust and really understand that they have options available before it's too late. Too late meaning that you've already sold the asset, right? Then even at that point, there are things that can be done. They're just not as there are things that can be done. I'll put it at that, but there are certain limitations. So anyway, thank you everyone. Appreciate you being on the call. Appreciate everybody that's been here coming and going with Jake and Jake Carpenter and Jake Meller. Everybody else, I wish you a very wonderful day and we will see you next Friday, same time. Thanks everyone.